Hey, what's up guys? John here. What credit card companies, lenders, and banks are doing right now says everything about the future of loans in 2024.
Bank stocks are really under pressure here. Some industry watchers say there are real risks ahead.
If you have an intention of buying a car, buying a house, getting a business loan, getting any type of funding, pay very, very close attention to what is unfolding. In 2021, during the heyday, you were able to go out there and buy a house, 3% interest rate. Your credit score really didn't matter. You would buy a car, record low interest rates. Some were even offering 0% APR for the first couple of years. I mean, it was a free-for-all. It was an incredible, incredible moment for tens of millions, potentially hundreds of millions of Americans. But when you look at what's happening now with record high inflation, high borrowing costs, and high interest rates, what you're starting to see is millions of Americans simply can't afford their bills, and they're turning to predatory loan products like buy now, pay later.
More Americans are resorting to buy now, pay later services to compensate for the high levels of inflation.
And some of these paycheck programs where they're charging over 300% interest, car title loans, payday loans, installment loans, all these lenders, these predatory lenders are coming out of the woodworks. But some of these lenders are not reporting the debt on their credit reports. And so these credit card companies and lenders can't see how much debt people really have. And so they're taking on more risk with certain borrowers. And because of this, they're cutting ties completely with a lot of these types of clients. In this video, I'm going to break it down and show you exactly what's going on so you can position yourself for this. I believe we're going to see a massive credit crunch coming, and with it, a lot of opportunity to invest and to make a lot of money. So please hit the like button, YouTube will share the content, educate more people about what's going on in America. And if you'd like to fix your credit, we would love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session for tomorrow. Take a look at this. So this came out today, February 14th. Americans with low credit scores use buy now, pay later more often. Well, look at this data. Researchers found that almost 60% of financially fragile consumers have used buy now, pay later 5 more times a year, with nearly 30% of them conducting 10 or more buy now, pay later transactions annually. That compares to just over 20 and 10% respectively for more financially stable users. But economists, attorneys, generals, and I would add credit card companies and lenders have raised concerns about buy now, pay later, noting that the lack of data, transparency, and formal regulations make it difficult to know and track just how much additional debt consumers are incurring. Buy now, pay later could lead to an increase in consumer debt, as consumers may be more likely to take on additional debt if they know that they can spread it out onto other payments. This is from Wells Fargo economist. So when you look at this and you see workers are paying to get part of their paycheck early, it's payday lending on steroids. Interest rate roughly 330%. Do you think somebody that has access to money is paying anybody that type of interest rate? The answer is no. It's a specific audience that they're targeting. People with bad credit in a really, really challenged position. That's what's happening. And it's across the board. Auto loan defaults on the rise, mostly subprime borrowers. Subprime defaults right now, 15.68% on credit cards. 15.68%. Imagine you were lending 100 people money, and the balance, you're not lending $100. The average is $6,360. So if you're lending 100 people $6,360 each, and 16 of them are not paying you back, would you keep lending to that specific target audience? The answer is probably not. You probably would not do that, especially considering the fact that President Biden right now is proposing to reduce the late fees and penalties on credit card companies to where, before they could charge a $35 late fee, or some would even charge even more than that, to, $8 to $10, $12 in that range. So reducing their late fees 75%. So if you think about it, if they're having a harder time tracking the amount of debt that consumers have, they have a harder time penalizing them for not paying them back, and they know that more and more people are likely going to continue to default, what will likely happen? They're going to look at risk differently. They're going to look at every single loan more carefully. And that's what we're walking into right now. Tight lending conditions to remain constant on U.S. growth. Fed said banks tighten lending standards fourth quarter. Loan demand increases despite tighter credit conditions, right? And when you have Jerome Powell and the inflation data coming back saying 3.1% in January, defying forecast of a slowdown, and then you see inflation data, the likelihood of Fed interest rate cut, what you're going to likely see here is higher minimum payments on credit cards, higher minimum payments on other bills. And so with it, more and more and more defaults. So you're going to start to see a situation in this country where people are going to get so desperate for credit, and there's going to be a lot of investors out there, a lot of really wealthy people saying, you know what, there's a market here. There's a big market. The payday loan market, sure, it's a multi-billion-dollar industry. Car title loans, sure, it's a multi-billion-dollar industry. But when you're walking into a situation where you have over 100 million people desperate for credit, you're going to see a situation where we're going to see insane interest rates. We're going to start to see so many predatory loan products start to pop up this year. It's going to be unreal. Especially as layoffs continue to skyrocket, who do you think is going to be most likely impacted? Do you think it's going to be the rich? No. Sure, you're going to have some, tech workers losing their jobs like we've never seen before, but we're going to also see a lot more small businesses that are going to be the ones that are, issuing more and more and more of the layoffs because they're going to be, paying a lot more to borrow money as well. And so if their costs are going to be going up, you just have to imagine what's going to likely happen. More layoffs, and it's just going to be a domino effect. It's going to be a ripple effect. I saw this and I thought, this is where the world's actually going. It's a dating app based solely on credit scores. So it's based on your credit, and if you have a credit score below 675, which is not great credit, the average credit score in America is 698. But if you have a credit score below 675, you can't join the app, right? And it's a very interesting concept because when you look at what's happening right now in society, people are looking to play defense. They're looking just to make it. They want to be able to, put a roof over their head, plan for the future, really kind of, make smart, forward-thinking decisions. And people are looking at dating based on, how they can, have something long-lasting. If someone has, really, really bad credit and they enter a relationship, then the other person gets penalized. If they want to buy a home and one person has really bad credit, it gets hard to jointly qualify for that mortgage. And so this is a really interesting app, and I think it just shows where America is going, where credit scores were almost irrelevant a couple years ago, and now they're becoming everything. Like it's really, really fascinating. And when you look at how big this market is, how many Americans have a credit score below 700? The answer is 40%. 40%. So of 258.3 million Americans, you're looking at a pool of 103,200,000 Americans that have bad credit. And so when you look at the writing on the wall, you can see things very, very, very clearly. That what I think is going to happen is there's going to be so much opportunity in this over the next couple of years for people that have a really good game plan. There's not going to be much opportunity for people that are borrowing at 330%. That's the sad reality. Anybody borrowing at 330% interest is almost a lost cause, right? Borrowing at 20% interest is insanity, but 330%, I mean, that's where we're at. That's where the market's at right now. So you start to see where this trend is going. You're going to see a lot of businesses being formed on the back of this crash. A lot of them are going to be highly profitable. A lot of them will be very, very, very successful. And there's going to be some that are simply not going to make it. But I'm telling you, if you look at the writing on the wall, what happened? Steven Schwarzman, Sam Zell, all these famous billionaires, these real estate tycoons, what did they do? When things hit the fan, they ran out there and they took over. They dominated. And that's what's going to happen. Middle-class Americans, like middle-of-the-income Americans, they're going to have their opportunity. I think it's going to be the last big shot to really go out there and do it. If you look at MetLife Insurance, CNBC, what did they say? They said in 6 years, 40% of all single-family homes in America will be owned by companies and institutions and investors. And it all makes sense because everybody else, as inflation rises, interest rates rise, everyone else is going to have a harder and harder time to be able to keep up. And so what do when they have a hard time? They sell assets. And who do they sell it to? People with access to credit. That's who they sell it to. That's what the world we're walking into. It's an unfortunate type of situation, but at the end of the day, facts are what matters. Emotion might change by the day, but facts remain constant. This is factually what is happening in America's economy and where we're headed. Credit scores are going to matter more than ever going forward. Job stability, cash in the bank, getting out of consumer debt, high interest rate consumer debt, putting yourself in a strong position will be more important over the next year or so than ever. Drop below. Let's have a conversation about this. And if you'd like to fix your credit to position yourself for funding, maybe a business loan, a home loan, a credit card, maybe a balance transfer, maybe you have high interest rate credit card debt right now, you don't know what to do, you don't want to keep spending 27, 28% interest payments to a credit card company. If you have a credit score of 730 and above, it becomes a lot easier to do a balance transfer where you can just transfer that high interest rate credit card balance to a 0% intro APR for between 12 and 24 months. No interest, makes it a lot easier to get debt free. So now is the moment to really get aggressive on your goals. So if you have any credit issues, we'd love to help you. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any issues at all in your credit report, go to GreatCreditFast.com, click the link in the description just below this video, schedule a free strategy session for tomorrow. Catch you next video.